profit, known as a taxable profit. Now, when talk about taxable profit in taxation, this is a profit we talk of, and therefore we say that this is a profit which is computed by an entity based on the existing tax laws, meaning that for us to be able to compute this particular profit here, we take only the taxable incomes and then we less all the allowable expenses. So therefore we say that this is a profit, computed based on existing tax laws, and therefore what I've said is that for us now to be able to compute this particular profit here, we only consider taxable incomes and allowable expenses. So mean that it is computed using taxable incomes and allowable expenses, or basically what in other terms we refer to as deductible expenses. Now, what we have said is that the reason why we have a deferred tax is because these two profit will be different, and that particular difference between the two profit, that is the difference between what we refer as accounting profit, accounting profit and the taxable profit may be classified into two categories. One, we do have what we refer as the permanent difference, and number two, we do have what we refer as the timing differences. So therefore, that difference between the accounting profit and taxable profit may either be permanent difference or a timing difference. Now, we need to know what is the meaning of those two terms. One, we have what we refer as the permanent difference. Now, when talk about a permanent difference, we say that this is the difference between the accounting profit and taxable profit, which arises because we have certain items of incomes and expenses which are considered or which are taken into account in the computation of accounting profit, but those items of income and expenses, we don't take them into account in the computation of taxable profit. Now, a very good example of that is what we refer as depreciation, what we refer as penalties and fines, because what we know is that for the purpose of computing now the accounting profit, or that profit which is in the income statement, items such as depreciation, items such as fines and penalties, all those items are treated as expenses. But when we come back to taxation, we know depreciation, we know fines and penalties, they are desirable expenses. So therefore, as a result of that, those two differences, those two profit will be different. So therefore, we have said that the permanent difference, this is the difference between accounting profit and taxable profit and taxable profit as a result of various items of incomes and expenses, expenses taken into account in the computation of accounting profit taken into account in the computation of accounting profit, but not in a computation, of taxable profit, taxable profit. Now, those particular items of incomes and expenses, I've said that good examples will include, examples of such items include what we refer to as fines and penalties, We have what we refer as depreciation on property, plant and equipment, what is abbreviated as PP. We also have what we refer as impairment loss on goodwill, Now, what we know from taxation is that all these particular expenses here, we say that they are disallowable expenses. But what we also know is that when preparing the income statement of a company, we take into account all these particular items of expenses here in the computation of the profit, or in the computation of the accounting profit. So therefore, as a result of that, the accounting profit and the taxable profit will be different. And basically that difference we refer to it as a permanent difference. And what we say is that this difference will only occur when those items are taken into account in the computation of accounting profit, but not in the computation of taxable profit. But that difference will never occur again. That's why that difference, we refer to it as a permanent difference. So we say that this difference occurs only once. Meaning that once the difference between the accounting profit and taxable profit arises, it will not reverse in the future. It will not reverse in what? In the future. As a result of that, this difference do not give rise. To deferred tax. Does not give rise to deferred tax. Do not give rise to deferred tax. And effectively what that means is that for the computation of deferred tax, we don't consider the permanent difference. So therefore we do have those as basically the various formulas which use in terms of computing now the free cash flow to equity